Hi folks, today I would like to discuss a topic with you that I already touched in my last video, namely why SoFi and the whole fintech industry are currently experiencing a massive sell-off, and it will not only affect the fintech industry but all overrated tech companies like Tesla, Apple, Alphabet and so on. And this topic is, in my opinion, absolutely important right now, because the media currently is writing or reporting what large financial institutions are doing, and that you, a long-term private investor, should do exactly the same. But why this is exactly wrong and what you should do instead, I explained to you in this video. And I'm sorry, that will be a long one. But I recommend to watch the whole video in order to get the full picture. And no worries, I will try to do it as simple as possible, means you don't have to be a nerd in order to understand it. Starting right now. The sale of tech stocks by the Fed raising interest rates and pulling liquidity out of the market, and thus companies that are high or overvalued will theoretically be worth less in a few years than they are today, is simply really very often misinterpreted at the moment, and where many long-term investors are now just starting to get wrong in the moment. Above all, I find that people who have been investing on the stock exchange since the last 2-3 years are now in danger and may see themselves as long-term investors, but are now starting to react differently because one or the other situation is now changing macroeconomically. And that is exactly what we are now looking at together. But first, let's take a look at the financial markets. Here you can see the Nasdaq in front of you. And for the first time, there is currently a very special situation. We've been running in a sideways trend since October, but there has been a massive development in the last few days. Namely, we really saw a significant drop of 3% in one day, and this has an important reason why. Well, let's have a look at CNBC. And here you can see already the Fed. In terms of the current development, it has been known since December that the Fed will start this year to raise interest rates and pulling liquidity out of the market. The reason for this is rising inflation rates, and the Fed has meanwhile also admitted in its minutes, which were published last week, they misjudged inflation. And when something like this happens, when liquidity is practically sucked out of the markets, then the individual stocks always get hit more than other stocks, and so-called shifts often take place. And that's exactly what's happening now. We are currently experiencing a lot capital is withdrawn from the technology stocks. What is exciting here is that, above all, many technology stocks that were considered absolute anchors in the last few weeks have now been losing massively in value in the last few days. For example, Tesla, Alphabet or Apple, which in the past few weeks have simply been a safe haven with their very strong cash flows and strong cash flow development. We see the same thing with Microsoft. So we see that all these technology stocks that were actually considered a safe haven, from which the capital is pulled, and where is it floating to? Well, that is the question. It flows into the old economy stocks like Ford or Exxon, or more conservative stocks such as banks, energy or bonds, right? And here's an example how the media suggests to us how the stock market professionals are now adapting their strategy for 2022. And many videos are now appearing on YouTube which get a lot of clicks and somehow go in that direction. The stock market professionals are doing this now, and for 2022 they are doing this, and the big mega funds are now doing this and adapting their strategies, and many private investors then often feel encouraged according to the motto, hey, when the professionals do that, then it has to be right. Yes, then I have to do it now as well. If the professionals are going out of these stocks and selling techs, then I have to do that too. And now I have to invest in other industries, which are now somehow practically benefit from the economic recovery and reopening. Then I must buy some energy stocks or banks or bonds. And in my opinion, that's the absolutely wrong way. That is exactly the mistake that one should not do right now. Not necessarily buying certain stocks, but doing something just because the professionals do it. And I would also like to tell you very specifically what exactly is wrong with that and what you should do instead. And I hope you're still with me, because now we come to the interesting part. So stick with me and I will try to make it as fun as possible, alright? So, and the point now is, what's wrong with acting like the pros? Well, you are not a pro and I am not a pro. We don't have billions in capital that we somehow have to manage. We are not big fund managers, we only have our small depots. And most of us, I assume, have less than $500,000 or less than $1 million. And as a result, we as private investors have clear advantage with our small depots over these giants, because they have massive capital to manage. But what does that mean in concrete terms? The professionals and big hedge funds and the managers manage gigantic volumes of capital, and they have to watch out for completely different things. They have to watch out every year, for example, that they roughly reach or beat their benchmark index every year. That means if you are, for example, Cathie Wood, your comparative index is the S&P 500 or the Nasdaq, for example, then you have to be roughly always at the same level. And what does that mean? Well, they first adjust a lot of capital and simply invest half or more of their capital volume in the stocks, which are also relatively high weighted in the S&P 500. That's why a lot of capital has flown into Apple or Microsoft or Palantir or whatsoever. The next point is, if you look at the Nasdaq, who do you think is responsible for this sell-off? You? Me? No, certainly not. Probably the big hedge funds, you would think, right? But only partially, because as I said in my last video, 70% of trading is currently happening on technology and trading exchanges, not by people, but by algorithms. These algo trades work with mathematical calculations and according to correlation with each other and against each other. What does that mean? Well, algo trades have stored certain values in algorithms, according to which trading templates are received. That is now in the concrete terms. If inflation worries rise, that can be measured by certain indicators, and at the same time the central banks go there and say, hey, we are now potentially increasing those interests and sucking the capital out of the financial markets. What do these algorithms do then? They sell stocks that are valued too high, means the PE value is too high, etc. And these algorithms are only looking for, is this company in this industry? If the industry tends to be more burdened by the inflation and interest rate worries, then sell off. And what do we see? We see massive sales across the tech stocks, like here in the Nasdaq or the S&P 500. No matter how the company is actually structured in detail, because these professionals now manage a lot of capital, hundreds of billions, they look or have to pay attention to their values. That means they have to see that they maintain or improve their average growth for the next 6 months or this year. So what are they doing? Well, tech stocks are being sold off, and on the other hand, they buy large market capitalizations of old economy stocks such as energy, banks, or even a Ford or Exxon or bonds. That is the game of the big fund managers and algo traders, and generally of this big financial capital, as we see the whole thing on the stock exchanges. And that's a game where I would say you should, as a private investor, do not get involved with. You don't need to anticipate economic developments and somehow carry out controlling in advance, because you are a private investor, just like I am a private investor. And we private investors have a great advantage that the big ones look a bit jealous of. We don't have to pay attention to how individual industries develop, and we don't have to pay attention to how the industry will develop in the next 12 months, because we don't have to answer for not having beaten any benchmark index. We as a private investor and you as a private investor have a golden advantage, namely you can be a long-term investor and you cannot beat the index for 1 or 2 years without being somehow fired. Instead, in these phases where a lot of capital from certain stocks is flowing out completely due to the large investors, you can pick out exactly those golden nuggets you always wanted to have and put them in your depot. The game of the big hedge funds and professionals is often irrelevant to us. We don't have to look now. In the next 6 months the capital will now flow in the energy sector. Yes, we have to go now as well. As private investor, we must position ourselves quite differently at the fundamental corporate level and carry out the analysis there. So really look at the companies in detail. But how do you know that right now you are about to commit a big mistake? So if you're going to think, hey, if the pros do that, then I have to do it now, because the pros assume that the industry will generate more returns. So now I somehow have to look for stocks in the energy sector or somehow other old economy stocks. And in the next 6 months there is more to be gained here than where I am right now. Then you are about to make a big mistake if you see yourself as a long-term investor. But what should you do as a private investor instead? Well, first, you shouldn't take the first step and say, I'm looking at a sector or stocks where more returns can be made in the next 6 months or 12 months, like the big ones. That is the wrong way in my opinion. Of course, we are investors too. We also look at our returns over the long term. That is the reason why we are invested in the capital markets in the first place, okay? But that is the wrong approach, because the return is always the last step. We instead have the great advantage that we can go and say, I'll take a look at this company now, and then I go through this company in a detailed analysis. And at the very end decide if the return on what I would generate with this company in the long run makes sense or not. Means the first decision whether to put a share in a depot as a long-term investor should not be the return, and not only the return, but the identification with this company and knowledge about this company itself. That is before you get to the point of returns. You should take a closer look at the company. That means if you just take your depot and take a look at it, look through your largest position, and then you have to answer the questions. Do I know the product that this company manufactures? Yes. The main product as well, and the main sales driver. For example, if you have a SoFi now, then you can say, yes, okay, I use SoFi myself as a bank and broker. Check. That is the first point. Look at the companies, look at the management, and look at the products, and then only when you decide, okay, this business is something for me, I can identify with the management, I can identify with the products, maybe even use these products myself. Only then you have to go to step 2 and 3 and take a closer look at the financial numbers, and then you might somehow get a certain return at the very end where you can say, okay, it is attractive, I'll buy. Or you can then come to the result that the company is really interesting and the product is really awesome, but the company is still a little bit too expensive. The difference between this aspect and the other, namely, oh, energy sector will increase, I definitely have to invest in there now, is the following. You go into this sector with an expectation of returns and just look for some companies where the big ones now put their money, but where you cannot identify with these companies. The problem is, only if somehow another trend occurs in 6 months and the central bank will suddenly not raise interest rates so much because the whole economy is on its knees, and then all of a sudden you have a stock stuck in your depot that you actually didn't want to have, but only invested purely because you thought there was somehow more returns to get from it. So My message in this market situation is very clear. Don't get confused and don't look at what these stock market professionals are doing. They have completely different things to look at, and they have to maintain a completely different responsibility towards their customers, and they can't lose them neither. That is, if they are not allowed to lose, they will orientate themselves completely differently. They will also have to invest completely different capital. So look into your portfolio and go through most of the positions in your stocks, and don't forget, you are here for the long-term game. You are here as a long-term investor. That is, you have already analyzed the companies, I hope you did, and therefore have invested in them. Means your feeling should be that if you had enough money, you would prefer to buy all the shares or the whole company, okay? But let me know in the comments below what you will do with your tech stocks, as this would be really interesting for me. And if you liked the video, please give me a thumbs up so other retail investors like you and me have the chance to see this video as well. And if you are on my channel the first time, I would be happy if you would subscribe, because I regularly produce new videos and tutorials on the topic of stock analysis, investment and financial products to give you the opportunity to take your finances into your own hands. That being said, if you like the content and you want to support my channel with a few bucks so I can produce more videos, I will pin a link to my Patreon page in the comments below. That's it for today. Thanks for watching, and as always, stay focused and don't get greedy. See you next time.